Yeah, thank you everybody for returning after lunch. We've got extremely light to digest first panel after lunch. Guys, all good luck to you.
Good afternoon, everybody. We are here to present what is the outcome of the draft discussion paper that was introduced this morning also by the OECD representative. We will try to be as less technical as possible, considering also the complexity of the issue that we are talking about and considering after lunch. We will start with the presentation of the discussion draft and focusing particularly on probably one of the most easy topic, which is the loan pricing. And we will then present one single case study, and we will show the purpose of this case study is to show how 4 different countries may approach the same case. So what has been this morning highlighted by the OECD representatives, we will try to show in practice how 4 European countries, almost neighbors, because we are talking about Dejan Mollo from Taxand UK, and Carole Chapuis from Taxand France, and Andreas Medler from Taxand Luxembourg. At the end, we will, of course, like to have some question and answer your doubts and concerns. So we would start with Dejan, who will introduce us briefly with the draft discussion paper content, which we understand this morning will be substantially changed as compared to what we have read this summer. We will see what the changes will be. For the time being, we are trying to fix the basic pillars of what is the loan pricing guidelines. And I leave the word to Dejan in this respect.
Thank you. Thank you, Stefano. So basically, over the past few years, we as tax practitioners and transfer pricing practitioners, we have seen things change quite a bit. I've been doing transfer pricing since 2005 now, and we're having discussions in between the sessions with some colleagues that every time we say there is a development, you know, it's an area that is going to develop and it's going to develop. And certainly the information that has been shared by the OECD goes into that direction. So there are plenty of developments. So in terms of the BEPS project, most of you will remember the 5th of October 2015 when the papers came out. So back then there were talks that we are going to see something along the lines of financial transactions. And we waited as a result. This year in September, September was July. Let's go. Let's get some help from the slides. So this year in July, we actually received the discussion draft that is giving some sort of information on what the OECD approach may look like. And I'm very careful in choosing my words now, having in mind what the lady from the OECD said this morning, because some of the stuff that we're going to talk about today is probably going to change over the next couple of months. So with this introduction in mind, so we received the discussion draft in July. The discussion draft included 20 questions and 43 pages. Can I just, in the interest of making sure that you guys are awake and that I am awake, how many of you, by show of hands, have actually read the draft? Okay, so 30, 40%. How many? 20%. Okay. There we go. There we go. The Italian is always very negative. All right. So how many of those of you who actually read the discussion draft enjoyed it? Not many hands. So yeah, it's pretty much 43 pages of highly technical, relatively technical areas. 20 questions which were also very technical, particularly around one of the topics that we're going to discuss in more details today. Now, the key bit about that paper, now that we've had that discussion with the OECD in the morning, is that it was a non-consensus paper. So different countries would have different ideas of where this is going, what approaches they will take. One of the key takeaways from the discussion draft, but I understand from the discussion today with the OECD that's probably not going to be a problem anymore, was in relation to the debt versus equity nature of the actual intragroup transaction. So if my interpretation from this morning is correct, I understand that the OECD has managed to get the countries to agree on that point. One of the interesting things in the discussion draft was that saying that each of the countries is free to actually interpret to interpret transfer pricing separately from all other rules that they have in place. So in essence, the OECD was saying we're going to do something about it, but we are not going to oblige all the countries that are participating into following that that approach going forward. Now, the draft can be divided into two sections. So the first section, or two two parts, I would say. So the first part is where you will make changes to Chapter 1, or basically how you delineate that transaction. So is it debt or is it capital? And the second part is in relation to the actual approaches, economic conditions, economic substance that would need to be taken into consideration when you're doing that sort of analysis. Right. The content of the slide of the actual draft is basically focused on four main areas. So the first one was the one that I mentioned to you, the changes to Chapter 1. The second one was the treasury function. So treasury function covers everything from intragroup loans, cash pooling, and hedging. Guarantees. Sorry, this is not just guarantees. This is financial guarantees, which is one of the key bits that interacts very extensively with pricing of intercompany loans in many cases. One of the things that was missing was, in my personal technical opinion, any discussion on performance guarantees, which for some of you may be relevant. And then the last section was focused on captive insurance. All right. So the treasury function chapter was dealing with these three main points. So intragroup loans, pooling, cash pooling, and hedging. And we're going to talk about today on everything or anything that has to do with intragroup loans. So these are the main areas. There are basically these 7 sections. So how would you normally go about to do an intergroup loan analysis? Starting from, are you taking into consideration the lenders and borrowers perspective, the use of credit rating, group membership, covenants, guarantees, fees, additional fees, as well as how would you put the whole picture together into a pricing approach. Now, I think this was a positive development. Why? Because I have seen in different countries tax authorities doing anything and everything, quite literally. So it's good to have a paper that we can say, okay, well, we are operating in an OECD country, and this is an approach that the OECD has taken forward. Obviously, the fact that it's a non-consensus paper doesn't necessarily help, but at least it gives you some sort of information as to what would be the right thing to do. It comes with a little bit of drawbacks, because sometimes you don't, the guidelines being guidelines, they're not necessarily very prescriptive, so they don't exactly explain what you should be doing, and they're open to interpretation, which is most probably driven by the fact that there are, was it 50 countries in the inclusive framework? Yes, about 50 countries, and probably that's why they're, they have included and then excluded some language, and probably that's another reason why, just for your information, the paper came out on the 3rd or the 7th of July, if I remember correctly, in 2018. I think, if my memory serves me right, it was supposed to go out in 2017, summer of 2017. Then they pushed it back for another few months, and then some information from HMRC, the UK tax authorities, was saying that the paper was so difficult to digest for the different tax authorities that they just couldn't agree. And at the end of the day, they just said, okay, well, it's going to be a non-consensus one, so because nobody agrees to it, and then we're gonna send it, and we're gonna make it public. So the information that is contained in those sections is quite is useful. It's useful. Some of the points I think were open to interpretation, and me personally, as someone who has been working in this field for quite some time now, I don't agree with some of them, but I try to be positive about the draft, and we're gonna take a look at 4 points now. So basically, in detail. So out of the 7 points that were mentioned in the intragroup loan section, we will take a look at the lenders and borrowers' perspective and how this is explained, the ratings, how you would use credit ratings, group membership or halo effect, as some of you may have heard of, that approach, and then pricing approaches, and we're going to discuss quickly covenants and guarantees and fees. Now, a positive development that was published in that paper was the fact that you would need to look at the transaction from a lender's and a borrower's perspective. It says that you would need to do that. It says that you would need to delineate appropriately the financial risks that the lenders would normally take. It says that you would need to be flexible from a borrower's perspective. So you need to take into consideration any potential options. You need to take into consideration how would, in an arm's length situation, borrower try to optimize their weighted average cost of capital and the cost of debt overall for the company. There is an interesting recognition. It's a positive recognition. The fact that you need to actually follow creditworthiness. You need to take into consideration creditworthiness. You need to look at credit risk, and you need to look at the economic circumstances from both sides. Now, one of the key language, which I think in the whole draft, in respect to those transactions, and particularly in respect to pricing, is covering what I call implicit collateral. So taking into consideration the fact that a intercompany loan may be subordinated or considered to be unsecured, can only be supported if there is another transaction in that particular entity, and it's not. You cannot just have one tranche of intercompany loan and just say it's unsecured, because there is an implicit understanding that the parent controls the subsidiary, and therefore you won't be able to get that additional few hundred basis points in order to take that into consideration in the pricing. Now, next, also very useful point that came out of it is the use on credit ratings. So now the OECD officially has come out saying that credit ratings are a tool that you can use. I have seen in a number of cases, areas, tax audits in particular, where the tax authorities just come and say, well, this is a commercial tool, it's based only on quantitative results, and it has absolutely no relation to what's happening in third-party to third-party situation. Because the banks, for example, will not use the same model. The banks will have their own models, or they will have their own pricing agenda, probably I should call it, because sometimes you don't know when you go and ask for a letter from a bank, is it that they're going to make money on this transaction, or are they looking at you as a client to serve for other financial products and from other departments? So now, the good thing about the draft was that they mentioned that credit ratings should be used, but they only say that the credit rating should be used to the extent that the process that you're employing is close to what the credit rating agencies would have done. So, to what extent can you actually demonstrate that, and is there a clear guidelines? Okay, if you do this, then it is going to be acceptable. It's not clear, because, well, one, you have multiple credit rating agencies, and they will have multiple models, and they will have different ratings and different things that they will take into consideration. And two, the credit ratings, I mean, this came out of the case in Australia. What was the name of it? Chevron. So if I remember correctly, the judge, so it was a big case where you have inbound pricing into Australia from the US or Luxembourg, is it from the US? Yeah, from the US, where the external financing that the group Chevron had was at around 1.5%, and they put a transaction into Australia that was at 7, 8, 9, large numbers for big amounts. So when the judge looked at the decision, he said, okay, because as you can imagine, the taxpayer had 3 different credit agencies in the room. They explained how they have done, and he turned towards the banker, because they had bankers as well in the room, and he said, would you actually look at what the credit ratings agencies do? And the banker just said, no, we don't care, we have our own models. So in essence, everything that you're trying to do externally, it went in the garbage. And there was some other considerations, which I'm not going to talk about in this case, but it was just an example of how subjective sometimes things can be. I think, so from the positive thing from the discussion draft is that they introduce the credit ratings as a viable tool, but then they go around and they say that commercial tools, hold on, what was the exact language? It's recognized that such tools differ considerably from the credit rating methodologies applied by credit rating agencies. So what you need to do is, when you use those sorts of models, you need to put another layer of qualitative analysis in order to be able to demonstrate and make it harder for the tax authorities to just say, to scrap your analysis. So that's my opinion, by the way. I don't think that's the OECD opinion, but who knows. Then, you want to say something? No? Sorry, it's hot in here. So that's on credit ratings. Then a favorite topic of mine, the effect of group membership. So currently, we can split countries in 2 camps. So some countries use what we call standalone rating. So you only rate a company on the basis of whatever their balance sheet, financial statements, and forecasts show. And then there are other countries who are usually saying, well, you need to take into consideration the fact that you're part of a much larger group, right? So there is a lot of conflict in that area, because some of the countries are capital exporters and other countries are capital importers. So every country that is capital exporter would usually in most cases, would prefer to use a standalone credit rating, whereas for capital importers, it will be more important to actually take into consideration the rating of the group. So, one of the questions, one of the big areas, and I think the lady from the OECD, I keep forgetting her name, mentioned this morning was around what are we going to do about group ratings? Should we use group ratings for determining the credit rating of subsidiaries as a starting point. So currently, those of you who have actually done similar analyses would know that you would usually take that into consideration. You will take into consideration the fact that you are part of the group. One of the reasons being that Chapter 1 already of the OECD guidelines already contains 2 examples on group membership and how that would, the rating of the subsidiary would be affected. But now I think the OECD is trying to get further down and basically say, okay, well, shouldn't we always start from the group rating, make certain adjustments, and get to a rating of the subsidiary? I think the answer to that question would be a typical transfer pricing answer, which is it depends. We will see from the discussion that we heard this morning, if I'm not wrong, the OECD said that this is one of the areas where they haven't been able to agree. So we will see how where this is going to go. But frankly, I don't think it's a good thing to take into consideration, and it's going to create even more mess than we're currently in. All right, draft my exertions. Let me see that I don't forget an important point. Yes, the second bit on the slide that you see there is basically a shortcut for the definition of what the S&P Credit Rating Agency calls strategically important subsidiary. So when you do the analysis and you do certain adjustments to the ratings of the subsidiaries, you need to take into consideration legal obligations, strategic importance, operational integration, sharing of common names, brands, marketing intangibles, as well as any previous support. So it's going to be very difficult if the subsidiary has been supported financially by the group in the past to claim that there is no, well, it may be the case if they have a lot more assets, but you need to think about that and how you would explain and make sure that you include that in your analysis. All right, and the last point is on pricing approaches, is probably the most useful one from the whole chapter, I think. First of all, no surprises, the CUP is the preferred methodology. Second, the draft and the OECD and the people around the table in the OECD forum, they have recognized that it's very difficult to have one single market rate. So, and quite frankly, from history and from experience, and we're going to see this with the actual case study, it's sometimes hard to even agree on one and the same range. So, so from that perspective, that recognition is somewhat useful, but at the same time, it's not that useful anyway. But, well, we take it, it's positive development. Bond issuances are now considered to be plausible alternatives to loan transactions. As many of you will know, bonds and loans are different instruments. Prior to the financial crisis, bonds were a lot more expensive to get, and they came with a number of how should I call it, administrative complications for borrowers, whereas loans are allegedly cheaper on the administrative fee side. Now, after the financial crisis, and there were a few periods during the financial crisis when either of those markets were not available, so borrowers basically managed to get money wherever they could. And in certain countries, I'm looking at Italy here, this is still the case. Now, another important point is average interest rate paid on external debt is no longer considered to be a valuable, a good CUP, a good comparable price. But they recognize that sometimes the cost of funds may be, a good approach to employ, particularly for pass-through entities. Whenever you have a FinCo in the middle of the structure. Another useful point here, and I'm looking at my colleague from France, because in France they have this practice, I would call it, to want to use bank opinions. So bank opinions were completely extracted from the viable options for pricing, and now they're considered to be discarded because they're not real transactions. And they also asked a couple of questions, one of which was, can we use credit default swaps as alternatives to intergroup loans? Okay, next. Well, the additional considerations were somewhat less, they were important. The point on financial guarantee was really around, is there a financial guarantee, and should there be a financial guarantee, what would be the impact on pricing? There isn't any very clear, well, they're discussing it in the other part, on the part on financial guarantees in more detail, but currently the pricing of the guarantee as well as the pricing of the actual transaction would need to be in conjunction with all the different factors, one being group support, the other one being the actual terms and conditions, the third one being the credit rating of the subsidiary, the standalone credit rating of the subsidiary. Now, covenants was an interesting one because we know, and that's an area where I personally don't exactly agree with what was said, we know that in particular, this was particularly true during the financial crisis, covenants were enforced by a number of lenders on borrowers, and there were additional fees at arm's length. What they were saying is that covenants are allegedly less likely of crucial importance, I think the language said, in an intercompany context due to the lack of information asymmetry. Now, this is not, if we're trying to replicate the arm's length pricing or arm's length conditions, this is something that we should certainly consider. To what extent you as a taxpayer manage to demonstrate that this has been adhered to during the life of the loan will probably give you the right answer as to what should be, what should be the treatment, and whether, for example, if you charge 100 basis points for the renegotiation of the financial transaction, you will actually be able to deduct those 100 basis points. So that's this. A very similar point was made on loan fees and charges. Well, actually, they were a little bit gray on the fees, saying that they would only make sense if you have seen it and you can demonstrate that you have seen it in a third-party to third-party situation. All right, what was the draft missing? Well, apart from what I already mentioned, there are the 3 points there are, I think, key, and there is a third one that I thought about yesterday that I'm going to mention. So I think the first one is the reference market. So when you're benchmarking an analysis, on a transaction, would you use the market of the borrower? Would you use the market of the lender? Would you use global markets? Would you use regional markets? And which ones of those will be considered to pass muster with the tax authorities? I have seen all of these, and we're gonna talk about this particularly in the Italian case. In a second, rating of the borrower versus rating of the issue. So this is a long. There has been a long discussion in the past. Okay, well, you determine, fine, you have done your analysis, you know where to get to in terms of rating of the subsidiary. Now, what about the actual transaction? Is the transaction equivalent to the rating on the transaction equivalent to the rating of the subsidiary? Because it may not be. The subsidiary may have senior obligations already, bank debt or bonds quoted on the market. So everything that comes on top of that would usually be junior, would be considered junior or mezzanine, and that needs to be taken into consideration in the pricing exercise. And the last point is a little bit of a cheeky one. I would call it. I've had a couple of cases where I've seen a couple of cases where the subsidiaries' ratings were higher than the ratings of the group. And in those cases, the tax authorities where the subsidiary was situated was claiming that they want better pricing conditions. In essence, saying, well, we, France, for example, France, we have, we own 60% of the assets in the group, and we are obviously a key, well, the technical term is a key obligor, or a senior obligor, and the group would not be able to take that money from the market if we weren't in that, in the group. So therefore, if you're borrowing at, I don't know, 5% externally, you should cut us a deal, and we should borrow at 4.5, for example. So that's one thing that it is not mentioned in here. And the other point that I was thinking about was basically capitalization of interest. This is particularly relevant for private equity transactions. What would be the acceptable practice? Would you do that in arm's length? Because you are obviously doing it in arm's length. To what extent will you be able to create that link between what's happening in the private equity world and any one particular transaction that you're taking into consideration? So I think that's it, pretty much. Shall we leave them?
Yeah, maybe you
questions?
have some questions on...
To make sure that you guys are awake.
Hi, Richard.
Now you're awake.
Okay, let's move to this case study. I just briefly introduce. It's a very simple transaction, basically. We have a loan. We can consider as a shareholder loan. We will see the conditions are, okay, it's a 5-year maturity, 5 years duration, 100 million amount, repaid bullet at the expiry date, a fixed interest rate, and is a subordinated loan. And we have assumed that the company, the borrower, is operating in the specialty chemical business. We have also assumed a BB rating on a standalone basis compared to a BBB rating on a group level. Now, you will see from what the speakers will tell you that how different will be the approaches in 4 European countries. So let's start with France and Carole, please.
Thank you, Stefano. Good afternoon, everyone. So in France, we are well known for the Eiffel Tower, for our wine, and now for our specific provision for intercompany financing. So in the French tax code, you have a specific provision on intercompany financing, which provide for a safe harbor interest rate. As on today, this rate is 1.5%, so it's quite low. And how is it computed? Is it just a mere observation of what is made on the market? So it's a mix of credit ratings. It's a mix of maturity, of various maturity, from 2 to 10 years. So from a financial and economic standpoint, it's not relevant. However, it is clear in our law that if you want to apply a higher interest rate on your intercompany financing, as a taxpayer, you have to bring the proof that a higher interest rate is relevant. So if you have a look at the French guidelines on that, it is mentioned that this proof is any proof, any kind of evidence that highlights the condition that you will get from a credit institution or a financial institution in similar condition and at that time. And in the guidelines, it is written that as an instance, such an evidence can be a letter, bank opinion, as you mentioned earlier. So we have a long story of case law on that. At the very beginning, it was very deceptive because we have a decision from the Supreme Court indicating that such relevant evidence is a binding bank opinion. So it's quite unrealistic, but it's what the judge considered as relevant. Now, hopefully, we have several case law, quite recent, in 2017 and 2018, which is more open-minded. So now the judge are considering benchmarking studies, lucky you, but they are very they are really criticizing this benchmarking study on various aspects. For instance, because the amount is not the same, because the business sector is not the same. We don't have so many comments on the credit rating aspects, which is, I think, the starting point. The approach in France, what we recommend to our client is to perform a benchmarking study and to have a very good relationship with your bank, to get binding if you if you can, or yes, or at least a relevant non-binding bank opinion. So let's switch to yeah, no you can leave that. We just for your information, we shared with you our own experience on the topic and the criteria in the search that are more important, because as you can understand, as you will have very tough discussion with tax administration and not hopefully with the judge on a later stage, you have to have a very strong benchmarking study. So, Diane or Stefano, thank you. So, first of all, what we did for the case study is that we perform a benchmarking study on Bloomberg database. Why? Because some tax inspectors at the international brigade have access to Bloomberg. But as we are supposed to reflect the condition we should get from a bank, we cannot use bonds. So we are paying the full price of the database for just using the loan section. So you will see later on that this is the main difference with my neighbors.
Okay, thank you, Anne-Carole. I think, yes, next one is about Italy. Okay, I think Italy, as Diane mentioned, there is a big question mark about what is the reference market, because it's, okay, it's not a secret that Italy has some issues with the debt. And just to have a little premise, I would say that first of all, we have a specific regulation regarding loan transactions dating back 1980, and making no reference at all to the credit rating of the borrower, which is quite unusual, I would say, and also making specific reference to the fact that the reference market should be the market of the lender. Not surprised, because normally you pay more in Italy for interest rate rather than abroad. Then, of course, the provision of these guidelines, very old guidelines, are conflicting, I would say, in large part with the provision of the OECD draft. And we will have, for sure, news when the OECD will release his final position on the financial transactions. We will see how this will be applied in Italy and to which extent Italy will accept the positions, the provision, for example, in terms of credit rating and reference market. What we have seen, broadly speaking, is that we have seen everything. We have seen interest rate calculated based on central bank statistics. We have seen applied legal interest rate. We have seen also in some cases, also court cases, where the benchmark based on comparable transaction have been accepted. Now going to the next slide. This is very quickly, we have used the Bloomberg database. More or less the criteria that have been used will be also the same that the other country would use. We have used borrowers resident in Western Europe, and we have come out with 9 comparable transactions. And if we go to the next slide, I think this is the more interesting one. What we see is that basically the search of the bonds as they are, of the bonds that we observed yielded a median of 2.5% interest rate. I would say that considering that the reference market, where these companies, the comparable are residents, are mostly not resident in Italy. There were only, I guess, 2 companies resident in Italy. We consider the possibility to perform 2 different adjustments to this benchmark. First of all, as the bonds are liquid instruments that you can sell whenever you like, at least if there is a market for this bond, we consider a liquidity risk premium. I would say that this kind of adjustment can be probably it's accepted in Italy, but I cannot give you for granted. But you can discuss and can be used as a tool to defend your position at least. Liquidity risk premium, of course, because the loan will be impossible to liquidate before the expiration. Then there is the big question mark, which is a very, very current topic, I would say. So the country risk premium, whether if you borrow some money to an Italian company, you can apply a country risk premium to take into account the specific condition in which the Italian company operates. I would say that this is going to be kind of tough to defend in front of the tax authority, but in our opinion, it's correct to consider this kind of adjustment. And I give you a couple of examples that we have seen recently also in the press. For example, the largest bank in Italy recently, last week, raised a new bond with a 400 basis point spread. Same kind of bond issuance 1 year ago, and rating unchanged. The spread, I think, was 70 basis points, so probably kind of 8 times more. And because of the changes in the conditions and due to the increase in the spread that we currently observe in Italy. So I would suggest that you consider this kind, and we had also with clients this kind of discussions recently. It's depends on on your appetite to risk and to which extent you want to increase your interest rate. In our view, it's supportable, but it can be challenged by the Italian tax authority. Just by, in order to make, to give you a view on what could be the different result, the outcome of an eventual tax assessment, we have calculated that the statistical rate based on the interest rate based on the Bank of Italy statistics in the same period was 2%. So 2% compared to a 3.6 or 4.3%, it's a huge difference, as you can see. And if we look at the market of the lender and we look at the statistic of the Bank of Luxembourg, we would see a 1.8%. So you can see what is the swing between the figures and what can be the room for different interpretations. I would now leave, I think, to...
I think it's me, but
yes.
Can I ask you a question before we go on? Stefano, it's for you, sorry. So in the case where you would actually compare the Bank of Italy and the Bank of Luxembourg, to what extent can you actually claim, and would that be acceptable from the Italian tax authorities' perspective, the fact that these are just aggregates rather than actual benchmarking of a transaction?
No, yes, I think that if you do not prepare any as a taxpayer in Italy, you do not prepare any benchmark, I would expect that the tax office would come out with an assessment based on the Bank of Luxembourg rate, because first of all, it's true that the Italian tax office recently acquired Bloomberg license. Personally, I've never seen an assessment based on their own benchmarking study on the Bloomberg. It's quite difficult for them, I think, to use, and much more easy to use directly bank statistics. Yes. Of course, we have been contesting in most of the cases the fact that the statistics does not give evidence or do not provide evidence of what is the credit rating of the borrower. So you cannot say that those statistics are comparable to your transaction.
Okay, thank you. All right, the case in the UK is probably, I would say, the least complex of the three countries, maybe only competing with Luxembourg, what we'll see in a bit. So the way you would approach that analysis from a UK perspective is basically you take a look at standalone credit rating. So currently the HMRC guidance still mentions the fact that it's a bit controversial because the law says that you have introduced OECD guidelines into the legislation, but at the same time the HMRC guidance is saying that you should do an analysis on a standalone basis. So this is the expectation from HMRC, and you also take into consideration the terms and conditions of the tested transaction. The search, so first step, determine the standalone credit rating of the subsidiary. Second step, determine the credit rating of the issue, taking into consideration any additional subordination, contractual or structural, other points that are necessary in order to get to refinements that you need to get in order to be able to actually start doing the benchmarking. Then the preference in the UK is that you, as in most countries, I would imagine, is that you try to be as close to the industry as possible. Now, unfortunately, even if you include UK and European borrowers, you open up the search in essence, you won't necessarily be able to find a lot of transactions that are industry specific. And as such, what you would do is basically open it up to the closest type of industry or the closest type of grouping that you can find. In our particular case, I think this was industrial companies. So after we did the search, we found 8 potentially comparable companies. One of the things when you guys are doing Bloomberg searches, you may have noticed it, but sometimes the transactions that come out appear to be duplicates, but there are very small differences in the actual pricing. So you need to, the difference is basically because there are one and the same transaction may be quoted on different markets. So you need to make sure that you're not double counting the same transaction. So out of the 8, we excluded 3 for that reason. Then the small permutation of this case study for UK purposes is that instead of being a euro debt, we made an adjustment to a GBP equivalent. And then we also had to take into consideration the fact that there may be some maturity differences. So obviously a 4-year transaction will be less, most of the cases will be less expensive than a 6-year transaction. So you need to take that into account in order to get to a 5-year equivalent. Next. Yes.
How did you determine the credit rating of the standalone companies? Did you use the...
We use the credit the commercial tools, as they call them, in the discussion draft. In this particular case, this was done with credit model, S&P credit model, which has, in my personal professional opinion, a lot advantages over the other run called RiskCalc.
Yes, which is very simple because the input, you basically have as an input only balance sheet data. So no other requirements, then they provide you the risk of default based on those data. So the risk that this kind of analysis is challenged is an actual risk. But we have to see to which extent the tax authority will be able to replicate a credit rating analysis at the same level that is performed by the credit rating agency. So I think this is going to be one of the most difficult exercise to determine the credit rating, yes. Technically speaking, is complex. I think Luxembourg.
So, thank you. So just for your information, South Africa has been replaced by Luxembourg. So for those who are waiting for South Africa, it's not going to happen tonight, but hopefully some other time. To make the case a bit more practically relevant, what I will look at now is like the back-to-back financing activity of the Luxembourg company. So I'm not going to look at the interest rate because like I think in practice, many of you will have like some group companies that are rather the borrowing entity under an intra-group financing arrangement, potentially with a Luxembourg borrower. Typically, that's not where it ends. I would nevertheless call it rather a financing company than a pass-through. Sorry, Dean, I don't want to come up with euphemisms
Another term
here.
called conduit. Yeah.
Exactly. Yeah. So maybe to explain you like where we stand today in terms of methodology, and to kind of illustrate that, it's important to know like how where we came from. 8 years ago, Luxembourg TP rules were not existent. With regard to back-to-back financing activities, the only TP document we basically had was like half a page, which was an Excel tool with 7 brackets, different financing volumes, and a certain number of basis points that we knew were accepted by the Luxembourg tax authorities. So you see like the level of sophistication has definitely increased over time. Coming from this kind of like Excel file simplified methodology, in 2011, we first introduced like formal TP rules in Luxembourg law, which were strongly inspired by Dutch rules, namely with regard to the equity at risk determination, which is like a lump sum approach of the lower of 1% or 2 million euros. Sorry, 1% on the outstanding loan financing volume. The methodology applied at the time was like remuneration, which was consisting of 2 elements. First of all, like a remuneration for the functions performed. And the second one was like a remuneration for like putting, or like a risk premium for putting the equity at risk. Now, end of 2016, we reached another milestone, I would say, and we again modified our transfer pricing rules with effect from 1st of January 2017. Now we have come from, rather moved forward to a credit rating or credit score-based system. The starting point of each and every analysis is like a credit rating, because in many cases we don't have such official credit rating from a credit rating agency available. What do? We analyze the key performance indicators of like the underlying company, the country risk, and the industry risk. And together with the financial and with the business risks, after having assessed them, we would arrive at a certain credit score. And this credit score already gives us a certain probability of default, which we can derive from databases. In our case at hand, we use Standard & Poor's IQ. So we can determine the credit rating and the different probabilities of default. The next point in that equation is the determination of the equity at risk. So what do we do with the equity at risk? It has replaced our lump sum approach, and I'm actually quite excited to see whether the Dutch will follow at some point. One time we're one step ahead, probably. We, based on the probability of default, and maybe there's like one important thing to mention, there was like, after the introduction of the new rules, there was a big controversy in the market, which probability of default to use. So the opinions were diverging between 1 year probability of default and up to 5-year probability of default. If you type that into the system and you get the comparables, the resulting comparables, you will notice that coming from 1 to 5 years probability of default increases the result exponentially. That would have also resulted in like significant financing margins being having to be realized by the Luxembourg company. So what were the Big Four doing in the beginning? They started with a more conservative approach, taking the 5 years, and systematically challenged our 1-year probability of default during the first audit cycle. After having survived that with like quite a few intense fights back and forth, the 1-year probability of default kind of was blessed by the auditors and finally became the new market practice. So for like a few amongst the audience who are advised by Big Four, you may have paid twice for the TP studies there, because after the change to the new market practice, the argument to update the TP study was that the market practice had changed, but that the result was more favorable, so it's worth adjusting the new TP report. So that's actually a quite significant change, and that all happened during the last, let's say, 1.5 years, because there was a lot of uncertainty in the beginning how to approach that due to a lack of guidance also. And now this is the new practice, which we actually refer to, or like we kind of got inspired by the Basel requirements, because a regulated financial institution would also rather use like a 1-year probability of default. What comes along with this is like the requirement to actively manage your financing activities. Because if you have only a 1-year probability of default, you need to review and check on a regular basis, at least once annually, to make sure whether the risk profile is still accurate or whether it has changed, and whether certain measures need to be taken, either on the liability side through capital measures or on the asset side, for example, which is anyway an important requirement these days to actively manage your substance of a financing company. Plus, from a beneficial ownership perspective, you need to have like a certain involvement in the management of your financing activities. So based on that probability of default, the next element in the equation, it's the loss given default. That mainly depends on the features of the loan. For example, the availability of a collateral or security, or whether the loan is subordinated or not, or what we could expect as proceeds from the liquidation of the assets. This is like expressed as a certain like fraction of the loan, expressed as a percentage, which we then multiply together with the probability of default with the third element in the equation, being the exposure at default, which is basically the expected outstanding loan volume after like 1 year, for example, in the case at hand, and which is basically driven by like the loan and interest payment characteristics. For example, do we have like an amortized loan, a bullet or balloon facility? So depending on the outstanding loan amount, that would also have an impact, but by far less than the probability of default. So the key element in that equation is the PD. Multiplying all these 3 elements together, timing, yeah, I will speed up a little bit. Multiplying these 3 gives us like the expected loss, and the expected loss method, being specifically mentioned in the OECD draft, is already like seems to be like state of the art at the moment. Having the result, of the equity at risk. This is also the minimum capital that we need to equip the financing company with, in order to be able to demonstrate that the company also has the financial means to assume the financial risks in relation to its financing activity. And then in a last step, we would kind of, based on the CUP method, derive a return on equity, which is like a net result before taxes. And maybe if we can skip to the next slide, I will quickly run you through this. The return on equity being expressed as a certain percentage before taxes, we would convert that, depending on the outstanding loan volume, we would convert that into basis points and gross it up by the applicable tax rate and by the operating expenses that the financing company is expected to incur over the years. And by grossing this up, we arrive at a gross remuneration. That means in the case at hand, 25 basis points would be the interest spread. We would be expecting to be at arm's length, which I think is in most of the cases a rather conservative approach. Nevertheless, those 25 basis points may be reduced by the operating expenses as well. So the net profit we will likely end up with in this case at hand would be 10 basis points. 13 basis points after tax.
Thank you, Andreas. Any questions? Okay. Now, I think that the takeaway from this discussion is that, of course, it's a very technical, very complex matter. Compared to the past, okay, the complexity and so we think that for taxpayers and for advisors, the real challenge would be to really get a balance between an accurate analysis, which respect technically what are the requirements of this kind of analysis, which are technically complex, and at the same time being able to explain and defend in front of tax authorities, especially considering that the level of the tax authority and the expertise of the tax officers in this field is not consistent across jurisdictions and is not consistent within the same countries, I would say. So we, of course, encourage to document properly the transaction and to try to find the balance again between accuracy and simplicity. So this is probably the most challenging task for us and for taxpayers. Thank you.
And coming back to Andreas' note, I just had a chat with the guy from the tax authorities. There's no thoughts about changing the Dutch rules yet, although from a transfer pricing perspective, it would be very logical to do so. So it will still be the 2 million or 1% of the outstanding loan. So for the time being, but there's much more happening in the Netherlands apart from that.